So for those 39 years, I thought I was like completely normal. Like, what's wrong with everybody else? What are you talking about? What do you mean you can't sleep because you have like a huge loss coming up, or you're managing $1 billion? What do you mean it weighs on you? It's just numbers. So that was my attitude to it all until I like had this revelation when I was 47.
Even in 2016, you were still like on the short bias against the market, and like this has been dragging on for a long time, and it's like also a little bit or quite a bit underwater, like 7 figures. And like when did you stop, like, or when did you change your mind and stop this?
Pretty soon after writing that comment in 2016, what happened was that you had a 1 day, like a really tough down day in the markets in 2016 when the Brexit vote fell. And I think I actually can't really remember, but I think that there was a down day as well when Trump won.
In the beginning,
But both those days, I mean, they almost closed positive on the day after down 10% initially. So both those events kind of spoke to me that even though there are a lot of economic imbalances and there is a lot of debt, and somehow my old theories would speak for like a continued downturn and a revaluation of all the stocks involved. And that's when I started understanding that this probably there's something wrong with my analysis, at least regarding where stock prices are going. But still, I would say about a year later in 2017. Now let's fast forward to 2018 and the fall of 2018. At that time, there was a corporate bond market freeze in the end of 2018, and stock markets, like, they crashed in the way that I had been forecasting and in a way that I was expecting, in a way that I would have thought this is the trigger. This is now the reset is starting. There's no way you can stop this, given all the imbalances. And yet, even though everything was like perfect for a continued crash, it just stopped, moved upward. There was this famous Fed pivot, going from talking about being on a like just an automatic trajectory of raising interest rates at least 4 times. They went on to lower them 3 times instead. And that pivot, which also saved the market, and that was the defining moment when I finally realized that for some reason politicians will not drop the ball on this thing. They will make sure markets keep going up, because it's the balance between debt and the perceived market value of all assets that is the important thing. And if you let asset prices fall, then the imbalances will show too much. It will throw a wrench into the machinery, if you will, and that just can't happen. So I would say it was the fall or the winter of 2018, 2019 that changed my mind. And sure, but I think that from before the market drawdowns in 2016 until about when I covered in 2018, nothing much really happened with my portfolio. I had already made most of my losses on the short side. I did go in and out a little bit. I mean, I also have some kind of a reputation for shorting Tesla for a while. But I early in 2018, during this whole funding secure debacle in the summer of 2018, then I realized that no, like, Tesla is completely uninvestable. I won't touch it. So just as with the market, so with Tesla, around 2018, I realized that this is not a game to be played on the short side whatsoever. So I finally understood this.
Yeah.
It took 4 years from retirement until I truly understood that maybe I was just lucky to be professionally active during a time when shorting actually was like kind of easy and profitable.
Yeah. Like in the 2000s, like in this era, right? So yeah. But then later on, you came back to the hedge fund industry again for 3 years. Like in 2020, did you have a totally different approach then? Because markets were quite different, compared to the 2000s. Like what was the difference? Like just roughly speaking.
Yeah. So the big difference was that at Futuris, my first hedge fund, where I was for 15 years, we were supposed to always make money on every single trade. Like if I was short banks, I was supposed to make money being short banks. But at Antiloop, I was instead always market neutral. So was supposed to have just as many shorts as longs in terms of total risk. And that just meant that I only had to make money on the difference. So as long as I choose better longs than I choose two positive shorts and just made money on the spread, then everything was okay. So that made it both easier to get in and out of shorts, because I wasn't really married to the cases per se, but rather was trying to find a way to time a good short. Typically I only short stuff that I think is too expensive, but with this approach, it was also even more important to get the timing right, because the timing had to be concurrent with my longs going up or at least outperforming the shorts.
Yeah. So what was an example? Did you do in sector stocks against each other, or what was an example?
That was my original approach, was to find the best sectors and the worst sectors, and then try to manifest those sectors in terms of taking 1 or 2 or 3 specific stock investments. So if I wanted to be long the oil sector, I might choose ExxonMobil, ConocoPhillips, and some other stock, what's it called, Chevron. That was a typical long, and a typical short. Let's see I was short Tesla as an example of something that had a negative momentum, that was extremely expensive, and that was facing headwinds in terms of increasing competition. That turned out very well. It was an extremely easy short in 2022. Once you got the negative momentum, and once everybody saw that there is competition heating up, then it was a very easy short.
This also brings me to another question. The Tesla in 2022, that was short, easy. That brings me to the question, fundamentals against the technicals. So I followed this Tesla discussion. I've been hearing this about many years before. There were many people going against Tesla. It's because in terms of valuation and everything, it was just crazy. But how does this machine work? Is it really totally unpredictable until the trend changes, and then everything comes together that has been said before all the time, but nobody was interested in this.
And there is no real formula, apparently. If there were, I wouldn't have lost so much money shorting any stock or any sector or a market. But however, for Tesla, I think the upside was created by Musk's complete command over his acolytes, his followers. But it wasn't all just thin air. It was also a question of, he actually made millions and tens of millions of people follow him, believe in him. Some even thought that he made something good for the environment. So they might have been willing to buy poorly constructed cars that were expensive, even though they were bad for the environment, but because they thought they were good for the environment.
Yeah.
And he has an extreme talent for cutting costs. So I think that is his absolute biggest genius, that he finds a balance between he cuts out anything that isn't absolutely essential. And he is famous also for saying that I'll always cut out 10 or 20% too much, and then I'll add it back if it's really needed. And that means that he actually was able to produce cars with a high gross margin. Yeah. It meant that he had poor quality control. There were a lot more cars with poor quality coming out of his factories than from other car factories, but they were still too few to really matter. I mean, if a real car company has like a 0.1% of lemons, and he had 1% or 2% lemons, it's 10 to 20 times as many, but it doesn't really matter because the buyers were already in love with him and with the idea of Tesla. And he's made the same thing in a way with SpaceX. But there he has also had this fantastic CEO. I can't remember her name now. Is it Gladwell or something? No, not Gladwell. Anyway, and she seems to have a total command over actual quality control. And he comes in and says, cut those costs. You can't do that. This has to be more efficient. And he finds his way. And then on the other side, he also, as an added positive note, he also is able to make the sales happen. When he has created enormous growth, both in terms of SpaceX launches and in number of cars sold by Tesla. It's amazing, really. And it's amazing that it took until 2024 before he seems to have hit a wall. I thought that this would happen maybe in 2021. Back in 2016, it looked as if the other car companies, they will have good models and be competing for real in 2021. But it took 3 years longer. Yeah. And why the stock still could go to 400 before it dropped to 100? That's the gist of your question, really. And I think that's just weird. It's momentum builds on a momentum, and also you have this indexation mechanics where I think he managed to create a constant free float deficit versus the index weight for Tesla, and he added fuel to the fire by creating some kind of call out of the money call option process where I don't know if he orchestrated it or if there were just other people doing it, but whatever happened, they managed to create this deficit of Tesla stocks. It was just a constant deficit of stocks, and I think that created that just completely weird valuation at 400.
So you mean in terms of demand, there's supply. There's not enough supply for is supply demand issue.
So there's too little free float. I mean, he sits on a lot of the shares, and there is the funds that need to have a certain index weight. They have to keep buying them from each other, and if you add on top of that a huge volume of out of the money call options. Before every expiry, then that creates another kind of deficit with a short gamma deficit. So I can't testify 100% that this is what created it, but it's a good story. It's a plausible story, and it could explain why the company got at least 5 times too expensive.
Yeah, it sounds like. It sounds like a plausible story. Yeah, or like a plausible explanation. Yeah.
And now we're at a completely different, will he be able to create an autopilot? Who knows? I mean, he has the worst autopilot, or maybe the best one. It's hard to tell. He has the worst ranked one. He has the lowest certified level of autopilot. And on the other hand, the users thinks that it's the best one. And there are several regions where he's not even allowed to sell it, at least not under the name FSD, which is just completely misleading since it's not a self-driving software. It's a kind of a driver's assistant software so far. It's a level 2. He's not even allowed to call it level 3, or it doesn't meet the requirements. He's nowhere near creating a robotaxi, at least from the appearance of it, whereas the others already has them. I mean, I was in San Francisco 2 weeks ago, and there are lots of Waymos driving around. So he can't even create a robotaxi. Even it's at least 3 years after he said there would be 1 million robotaxis. 4 years after, I think. So there is there's something really weird going on.
So the answer to the question is pretty much is a mix of everything. You need to have some fundamentals to get this started, and then the trend can feed on itself through the momentum and some what you explained with the options and everything, demand supply issues, and then also the narratives, because isn't that finally what also the markets it's the same with the Fed and everything, it's a narrative, and the QE, technically it's not money printing, but everyone thinks it is, and so it's just feeding on itself, and there are so many narratives, and not all of them are true, but even though they are maybe not true, it still works, and that's it's not really what do you think? What percentage actually is fundamentals in the market? Is it
one way to express it is that this is really John Hussman, Dr. John Hussman, who's a hedge fund manager. Yeah, this is his way of explaining things. It takes about 12 years before fundamentals really take over and fully explain the market level. Sometimes it can take 20 years, but over a period of 10 to 12 years, that's where he finds the best correlations between actual value created and the market price of a stock. Sometimes he's also pointed out that for single stocks, the majority of the actual market price can be explained by fundamentals. So it takes 4 years to turn the narrative from just pure speculation and idea into actually being based on fundamentals. And then there's of course a wide range depending on what industry we're talking about. But so I mean, if it takes 10 years for fundamentals to actually matter or dominate the pricing function, then maybe you would say that fundamentals is just 10% and technicals is 90%. And I think that's kind of true. If you look at a specific stock, a specific year, like GameStop or Tesla or an oil major, what you'll get is just the current market sentiment, the current flows, the current, whoever happens to be interested in that stock or that sector at that very moment. And most of them, they don't care at all about price earnings ratios or return on equity or price book. They don't care at all. Maybe they haven't even heard of it. I run this finance course, the investing course, where I tell my students about fundamental analysis and valuation. Yeah. And the first reaction is typically so there's some kind of a formula for valuing the company.
Yeah, but this is retail investors. This is retail. I mean, it's just a small part of it.
Yeah, sure. But if you go to professional investors, then 80 to 90% of stock trades are just made by valuation agnostic money. They are momentum flows. They are CTAs, like hedge funds that follow momentum. Yeah. They are index funds that only buy based on inflows and outflows, and they don't care at all what something is valued. They only care about the index weight. So 80 to 90% of everything you see happening on the stock market, that's just price agnostic or valuation agnostic. So even if there might be like a person with a financial diploma sitting on top, but they don't care.
Okay, so it's not about don't know, but don't care. So it's or it's not in the process, or it's not like what their job is.
So what I was at Futuris as a fundamentally based long-short equity investor and focusing on actually trying to make money on going long certain equities, I was in a very, very small minority that actually tried to understand what they're doing, how they create value. Is it a Ponzi scheme, or do they actually have some kind of moats and a value creation method? And then buy based on this and hoping that within, hopefully within a year that the rest of the market will understand this. But even at that time, I had to take into account that, all right, if I fast forward 12 months or 24 months, what will the rest of the market be looking at? I mean, what if they look at this company that I have singled out? What will they see? Will they even see it? Will they even care that it exists 24 months from now? And it doesn't matter whether it's cheap or not, because there are so few like fundamentally based long investors. That are value based.
That's interesting. What do you think about the in terms also of this systematic versus discretionary decision making? What's your? I mean, you certainly use both of it in some way, but to make decisions. But what's your take on this? For example, some say systematic is the only way to go. Others says, you have to be totally fundamental, because otherwise it's just noise. But most use kind of both. So what's your take?
Well, as a value-based investor myself, I always start with the fundamentals. That is, I mean, I will not buy a stock if it's not cheap. I want to know that I can hold on to the stock forever. And even if nobody else ever notices this, at least I will get dividends in the end. And I have an interesting story here. I mean, I am a small minority shareholder in a company called Credit Safe, which is it's a credit scoring company. You might even have gotten some kind of letters in the mailbox from them where they say that somebody wanted to check your credit. So that's Credit Safe. And I bought stocks. It's a privately held company. I bought stocks in it for 20 years ago. I mean, I can't sell it unless I try to gray market it to other holders, but I just sit on them. But I have a 300% annual dividend yield
on your buy-in.
Yeah, on my initial investment. So it doesn't matter if the stock is worth zero. I mean, I still will get my value. So that's my main prerequisite for buying a stock. And then you have the next part, like the momentum or the trend. I'm careful with buying falling knives. Because you never know that you actually understand the story. I mean, somebody who's actually an insider or a long-term shareholder is actually selling the stock, so you better really know what you're doing if you want to buy something like that. So I'd rather wait for a really cheap company to bottom out and then start showing some kind of positive sign, some kind of positive momentum. And in a way, you could just turn this entire investment process around and only look for stocks that have a 3-year huge drawdown, but a 3-month positive stock price performance. And among those, start looking for something that's also fundamentally cheap. So it doesn't really matter which order you do it, but my most important factor is that it has to be cheap. And then, I would really love some kind of a positive momentum as well. But perhaps wasn't really what you were asking. Maybe you were asking about funds that are systematic or discretionary.
Oh, yeah, that's a great answer. I mean, the questions are also like pretty much flexible. Like that's a great answer, because like this is the classic value momentum combination strategy. I mean, I've heard the concept before, to like take value stocks and then wait for the momentum to start going again, and then to like take it as a turnaround candidate or something like that. So that's
the main other person at Antelope hedge fund, where I was the last 3 years.
Yeah.
I mean, he's only systematically based. He has like a catalog of 50 patterns that he has collected over like 25, 30 years as an investor. Yeah. And he applies them to different markets, different instruments, different asset classes, and he has them on different time horizons. And what he's, I mean, we work together. I'm a complete fundamentalist and he's a complete like systematic investor. And still we discuss both momentum and fundamentals between each other. And what he does is he lets his models completely dictate his trading. But what he really does is he lets his models suggest, like for example, the three best trades this morning. And then he lets his own intuition choose which one of them to actually implement.
Okay. Yeah.
So they are all really, really good according to the models. But he will have the final say which one to implement.
Yeah.
And his intuition is probably based on fundamentals as well, in a way. Like subconsciously, he knows about the market, he knows about politics, he knows about the Fed, etc.
All right. So one more here is like. Yeah, also like being able to take big risks to make like what's, or maybe also like in the past, maybe also today, depending on like how you want to frame it. Like, how important is it to take at the right moment, take big risks, which may also be a big drawdown later, but like if it's going well, like. I remember your decision from back in 2009 when the market changed. Like, for example, like what's the long-term importance of being like greedy at the right moment and then just like risk something? Or do you think maybe people, or like many funds today, they are so like risk averse and regulated that they don't, or like benchmark oriented, that they don't take enough risks at the right time, which maybe in the past was different?
I think from a business point of view, you should take very little risk. Once you have your assets under management, you will earn fees forever as long as you don't make a fool out of yourself.
Yeah.
So you should never stand out on the downside. That's the like. If it's important for you to have a very long-term income and become, let's say, rich, then the way to do it is to milk your investors with fees. Even if you're slightly underperforming the markets every year from then on into eternity, you will keep your money. But if you have one really poor year when the market is doing good, then you might be out of business right away. You'll get fired, or you'll get fired by your investors who just move on. So that's the immoral way to do it.
Yeah.
But if you're starting out new and you want to build something, then it's the other way around. You have to perform really, really good for, let's say, one super year, one stellar year, or maybe 3 really good years to make people notice you and make the analysis that, well, it probably isn't just a one-time lucky shot here. Like if it's done it for 3 years, and we can see how he has done it. We see the Sharpe ratio, and we see what type of holdings and how concentrated the portfolio is. There's a certain kind of metrics that you can point after 3 years to he probably knows what he's doing, and I want to be in on this. He seems hungry. He's performing. Well, let's hope he has a hot hand here, which is probably not true, because nobody really knows what they're doing. Like the Renaissance Capital, yeah, they do. They have a model, and it has proven itself year after year, decade after decade.
I can send you a critical article about Renaissance.
Yeah, but it works as long as it works.
Yeah.
And the same thing goes with fundamental investors. Like 3 years is nothing. Typically, I mean, I read a paper several decades ago that just said that even after 30 years of outperformance, you can't really say if it's skill or not. You still don't have the requirement for just a typical normal distribution with a nice 5% risk level, even after 30 years of outperformance. So that goes for Renaissance, and it goes for me, and it goes for like everybody. So in effect, you can't say anything about a fund manager, and you never know when disaster strikes. Like there's the fat tails manifest themselves, so that specific investor will fall off. Look at the VIX funds or the inverted VIX funds. That's what happens. Or banks and hedge funds in the GameStop scandal, or in the 2008 crash, or just Silicon Valley Bank recently. People they think they know what they're doing, they're taking risks, they're performing, and then suddenly they are out of business. So my answer to all this is that no, high risk is not the way to go. High risk only means you have a high probability of defaulting. It does not mean that you will create a high performance. Sure, you need to take some risk to get a high performance, or at least outperformance. But the higher the risk, the higher the risk that you actually hit zero and will not come back.
Yeah, but also in terms of like at the right time, like there are some inflection points, which of course is in hindsight, it's much easier to see than like in real time.
Mm-hmm. So for example, I mean here, sure. Yeah, I understand what you're saying, and it's exactly right. Like in 2009, when we went from being 50-60% net short to 100% net long in like minutes or a day or so. Mm-hmm. Some would say that's what kind of business are you running really? What type of risk are you taking? And still, we only went to market weight, being long only 100% long. Some would say that that's zero risk. And others would say, but you're putting your being good at shorting reputation at risk. Extremely much so. After a perfect home run in 2008, and you're still 60% net short, and the world seems like it's going to hell, and you go 100% long. So how do you actually view risk and measure risk?
Yeah.
In a way, we went to zero risk from extreme risk, being net short. Some would say that's suicide, being net short the way we were.
Yeah.
Let's see, kind of lost track of what I was really after here. But yeah, sure. Yeah. So, when things are cheap, like really cheap, if you go leveraged long, if you take extra risk, you're really speculating in with risk, the risk of not only defaulting, but actually owing money after the fact. That is the wise thing to do. That is rational to do when things are really, really cheap. This is what Howard Marks has done in the junk bond sector, where he said, sure, this stock is rated CCC. It's junk of the junk. It's got 10% probability of repayment, but it's valued at 2%. I mean, there can't be a lower risk, a better expected value investment than that. And that was his conclusion, his analysis, and it's of course completely right. But at the time when he started doing this, people thought that no, that's completely uninvestable. You can't buy something that's already rated for bankruptcy. They don't even have half the cash flow needed to repay their bonds.
Yeah.
No. But they got 5 times the cash flow needed to repay 2% of the bonds.
Yeah.
So they are super cheap and super safe. You just have to wait for the bankruptcy court to give us the money. That when you see things like that, then you go for the kill.
Yeah. Okay. Yeah. So wait for the
it's the price. Price decides everything. Like if you buy a bond, you know you will get 100 back. If you pay 80 now, you know you will make 25% return. You know that. The same goes for stocks. It's just that you don't know if it's 100 you're going to get back, or 400, or maybe 50. But if you buy at 25, and you have a very high probability that it will end up between 50 and 400, then you have almost locked in at least 100% profit.
Yeah.
But if you buy it at 800, then you have almost locked in a certain minus 50% and probably minus 90. So the price paid now, it decides 100% what your return will be.
Yeah.
Because you're selling at or the value sometime in the future. It's already decided, even if it's not decided, but it will be what it will be.
Yeah. In terms of the performance and track records and everything, like what's your take on the importance of on the one hand have a very good from an objective point of view a great track record, and on the other hand to tell a good story about the manager, about what they are doing, like to collect assets under management. So what is the importance of those?
The storytelling and marketing, portraying yourself, all the superficial stuff is worth at least 10 times as much as the actual track record. And I know this firsthand. I know this from Futuris. Even after we won the European Hedge Fund of the Decade Award, after 10 years of stellar returns, no down years, despite being like arguably the worst period in the stock market history, with ups and downs and interlocking bubbles and crashes, where, S&P dropped by 55% at two times, and in between in amazing rallies. Despite that track record during that period, despite being the same managers with the same strategy, like no style gliding, nothing weird, and we were also quite a big fund for that time. Like we had $1 billion, or at least 500 million for most of the relevant period, which was, you could scale it up at 10 today to make a relevant comparison. So we were one of the prizes we won were for big hedge funds. Big defined as more than $500 million. That says something about the climate and the time of day. And still, I went on a trip to Switzerland and the UK and France to market the fund and try to pull in money. I met with, can't really remember now, like 100 or 200 large asset managers that were looking for something new, something different, something complementary to their portfolios, something with that would give them a more efficient frontier in terms of their investments. Futuris would have been should have been the perfect box in their matrix. I managed to get 0 sales.
Oh.
0. Not even one small exploratory ticket from all these meetings. And it's because I'm a bad storyteller. I told it like it is. I told who we were and how we did it, how we invested, what we were thinking. I just told the story just straight up. No training, no marketeers, no agencies helping me craft a story or research what they wanted to hear. I just told it like it is.
That's crazy.
Zero.
Zero. If it's really 100 or 200, and you have this great track record at the time, and that's really crazy. Yeah. Okay.
Yeah. Then sometime after that, actually, in just when I had given up, I said I will not meet with one single client anymore, not a prospective client. Now I'll just stop. I mean, remember, I was the managing director, senior partner, and portfolio manager, one of three, and I just said I'll stop meeting with prospective clients because, well, apparently we're getting zero back from it, and I'm just wasting my time. And about a year after that, the institutional sales at our parent company, they managed to bring in a Middle Eastern account that put in $100 million, on just one investment, so the 10% of the fund, and it was because they had their own rules. They cannot invest more than 10% of the fund. They can't own more than 10% of the fund, and their minimum ticket was $100 million. And at that time we had 900 million, and they were like, okay, but if we put in 100, then you have $1 billion, and then we make up 10%. So it actually fits. But I wasn't involved in this sale, so we got this super big ticket for us. After I stopped marketing, so I had negative, my way of narrating, so I had a negative value.
Looking back on all the time in the fund management industry, those many years, what from today's point of view, looking back on this, what would be your advice to young people interested in this job to get started, what to do, what not to do?
I do get that question a lot, and sometimes I just say just go for it any which way you can. Just start investing yourself, start building your own track record. Try to make it in a way that you can actually demonstrate that you have made these trades. Make sure that they are not stupid trades. Nobody will pay you for a stellar track record in terms of performance if the stocks you've held are penny stocks or GameStop kind of stories. That doesn't account for anything. It has to be either very systematic and replicable and easy to convey exactly what you did and why it would work, and also perhaps hand over the model to somebody and say, try it yourself. Or fundamentally based, you have to really show, these are my big trades. They are made in pretty big companies. The fundamentals are sound. My research was sound. So you have to demonstrate that I'm interested. I have done this for a couple of years. It works. I did it in a serious way. And if you keep doing it and keep talking about it, then either your portfolio will become big enough that nobody will ignore you, and also you won't need anybody. Yeah. You are your own portfolio manager.
Yeah.
And sometimes I just say that just don't do it. If you're in it for the money, then you'll just be disappointed. Most people, this is like sports, golf, for example. There are hundreds of thousands of people in the investment industry or finance industry, and they are just toiling away 14 hours a day, never getting anywhere, never getting any sleep, not getting any real friends. Some of them sooner or later maybe they get rich, but they are spent people. It's not a good way to go, unless you really love the actual process of investing. But then we're back to the first example anyway, do it yourself. A third way, sure, you can go the traditional way, which I happened to do, even if it never was my intention. You go to business school. You make sure you have the best grades at school. You should at least be top 10 of a good school. Otherwise, it will be difficult to get in in a good place. And if you don't get into Goldman or BlackRock or Brummer Partners, if you don't get in there immediately, it will be difficult to rise in the ranks, because you will have already proven that you are not top material. So you can tell again that I'm painting a very negative story here. It's very difficult to find your way into high finance. I was like extremely lucky to stumble forward in the way I did and happen in on the right places. Probably both because and in spite of my personality, that I am just completely stupidly honest about everything. So I'm like an open book, and therefore I'm not dangerous. You can see that, well, this guy, he will work his ass off, and he will tell us about what he's doing. He won't hide anything. We can probably use him. Just throw him at the problem. But I could just as well have just been dismissed as like he's crazy. You can't use him. You can't put him in front of clients. Well, apparently you couldn't either. So, but it's the whole idea of a finance career. I think it's a very difficult sell. It's difficult to make it, and it's very hard to recommend. I wouldn't recommend it. Unless you really, really like sitting in front of the screens and just like looking at numbers and charts and trying to make the best investments. And again, then we're back to example one. Yeah. So I don't really have any good advice for a career in the finance industry, except just you have to be the best.
Yeah, okay, yeah, like what you said before, it's like in sports. If you're the best, then okay, one of the best, then it's probably much easier than for all the rest of, but to be the best is very difficult, and not many can be the best. So, and it's still, there's thousands of active fund managers out there and competing, and it's like a big battle all the time. So,
but if you're willing to do the work and not get paid for it, like because you like it, you like playing tennis, you like playing golf, and you don't care. You can go minus and you'd still be happy. Then just go ahead and do it. And maybe you'll get rich as well on top of like having a fun time.
Yeah, I was also thinking about going into fund management like 15 years ago, and then realized my results weren't good enough. Like I did some momentum models and everything, and I didn't do it and became a financial journalist. So it's much easier probably, and you don't get rich with it, but I don't know. But I also saw the downsides of the business. I did quite a few internships also in banks, and like I've seen a little bit of the other side. So I'm not that unhappy to not have done it. So, and also there's lots of bureaucracy and rules and meetings and like paperwork and So it's probably much tougher than people see from the outside.
And like this actually applies to your career choice, because if you were to get the question, like how do I get successful and rich, not the least, as a journalist, you would probably answer, don't do it to be rich. But it's rewarding. It's rewarding. It's fun. Like and sure, you make decent money if you're good, and if you're absolute best, then you might win prizes and get big salaries and do shows and whatever. But that you do it because you like it.
It's probably the same in all the jobs, right? So some more or less, but like somehow finance is always been viewed from the outside like, oh, he's working in finance, he must be rich, like so. Like the public view of this like it's something most people don't really understand, and even people working in finance, most of them don't understand like all this stuff. And
and I think I have at least I have a small hypothesis of why that is, and it's because it's soulless. I mean, it's nobody, very few really like working in the industry, but it has one perk: if you get rich, then at least you get rich, and then you tell everybody about it. So it like you always hear about people in finance being rich, telling you how rich they are and how easy it was and what type of lifestyle they have, and it's because they don't have anything else. But if you're a medical doctor, then you have being a medical doctor, which is super. Or a golf player or a journalist, like you have other values, but in finance you really don't.
Yeah. Yeah, that's a good idea. Yeah, it's a good hypothesis. Yeah. It's all about like success and being dressed nice in a suit and appearing great. Like, yeah. It's a lot about appearance also. Yeah.
Mm.
Finally, or almost finally, what's your trading? Like, how do you trade today? What basically, just roughly, what's your approach?
Sure. I have like 90, maybe 95%. It's hard to really measure of my financial assets in private companies. So like a dozen or so of private companies within lots of different sectors, like gold mining, in human resource software, investment companies, credit safe for one. So like any kind of sector you can think of, I've been in. I mean, I also had like maybe around 10 bankruptcies in my private portfolio, and I still have about 10 live, really good investments. I've had a couple of like actually 100 baggers, maybe I would say 3, depending on how you calculate it. But those 300 baggers, they're kind of balanced a little bit by 10 bankruptcies. So, but I'm doing okay in my private portfolio. And then I have like 5% of my financial assets in a publicly listed portfolio. And so it's important to know the orders of magnitude here, because then I'll tell you that my public companies, the ones that are actually listed, and I have them in my portfolio and I trade them a little bit, I change the portfolio's composition every now and then, they are extremely risky. And it's because if they are to matter at all, they have to be potential like 10 baggers, at least 10 baggers potentially. Yeah. That makes up for a kind of irresponsible, very manly type of portfolio of tech stocks or bombed out financials, high leverage, like junior miners. It's not really it's not a recommended portfolio for anyone, but so that's about 5% of my assets under management, or my financial assets. So not counting my apartment and stuff like that. But anyway, if you're interested in what I actually have in my public portfolio, then my biggest holding is a Kazakhstan company called Kaspi.
I've seen that on your blog. Yeah.
So it's like a WeChat or something like that. So it's actually like maybe more like PayPal, but it's like PayPal and WeChat, that kind of a combination of online payments, and asset light company growing quickly. Kazakhstan is growing quickly. It's extremely cheap. It's less than PE 10, and it's growing its profits by about 30% per year. So even if they stay at PE 10, then you'll still get 30% returns every year, plus a dividend of about 7%. So like almost a given 37% compound per year, unless Kazakhstan is taken over by Russia or the uranium sector completely collapses. So their economy collapses. But as it looks now, it's a fast-growing country and a fast-growing company, asset light, very cash flow positive generative. So that's my biggest holding.
Like, when did you start to invest there?
Well, I bought in just a couple of months ago. Actually, I was lucky enough that my partner in my educational online educations, the investing course. Feel free to check it out.
We'll mention it also in the article.
Okay, cool. Because I distill all my knowledge over the last 30 years into that 6-week course. Anyway, my partner, he found Kaspi like 3-4 months ago, and he noticed that they had been recently listed as a US ADR, which made it suddenly possible to invest in easily through Sweden. Yeah. So both he and I were lucky enough to get in at $87 per share. It's now at 115. So, but we've only been in for 3 or 4 months. We went all the way up to 136. And I think that a good target for the year is about 150 for the end of the year, something like that. And then on top of that, you'll get about like an $8 dividend. So it's like cheap, growing quickly. It has everything going for it. This is the Lollapalooza that Munger would talk about. Like, don't be a timid little rabbit. Let's just go all in on that one. Except for the Russia part.
Yeah.
So don't go all in. But it's my largest holding.
Yeah. Okay. Yeah.
So as I said, my portfolio is irresponsible. Just to keep that in mind.
But but for this small allocation, why not? I mean, that's what, like you said before. Yeah.
And my second biggest holding, it's at least as irresponsible. It's called Canagold. It's a super small junior gold miner in Canada, and if we're lucky, they'll start producing gold in like 2027. Yeah. But that's given they get the right financing and that they actually get a permit from the local, indigenous population. Okay. So that the Tlingit First Nations Indian tribe, they have to hold a vote next summer. And if they say yes to building a mine right into their ancestral lands, if they say yes, which I actually think is pretty likely. We talk to them on a weekly basis, and the main holder of Canagold is a friend of mine. He's a Colombian billionaire, and he's also an Indian, but a Colombian Indian. So he's kind of speaks the same language as they do, and we're pretty sure we'll get a yes vote next summer, and then Canagold, they have about 100 times worth of gold than the current total market capitalization.
Okay.
Sure, you have to get it out of the ground, etc. But and most importantly, you have to get the permit. So you have Caspi and Canagold. Those are my biggest investments, and maybe the only ones really worth mentioning. Then I've got some uranium companies and some other mining companies as well. And EMX is possibly the only one really worth mentioning. It's a royalty streaming company focused on copper, gold, and then battery metals. So Caspi, Canagold, and EMX, those are worth mentioning.
Yeah. All right.
And I only have five real investments in this portfolio. So Caspi makes up 24% of the portfolio, and the Canagold 23%.
Yeah. Yeah, great. Thanks very much. Maybe one final thing I just thought about taking losses, all this ups and downs, volatility, huge wins, from a distant point of view, this crazy business, so to say, and all those many years. How did you mentally manage all this volatility? And you go from devastated to euphoria and back and forth all the time. And how do you manage to stay sane, over 20 years with this stuff, or 25?
I'll try to make this as short as possible.
Yeah.
But when I was 8, I saw my big brother drown.
I've read about that on the web. Yeah.
And that caused a huge psychological trauma for me and my entire family. We were all witnesses. He just was pulled under and disappeared in a quiet, small town harbor in Sweden. I didn't know it at the time, but for the coming 39 years, this happened when I was 8. For the coming 39 years, I was locked away psychologically. I was impervious to any kind of psychological pain, because I had already lived through the worst imaginable one, and then that part of my brain got just locked away. So I became, I was called stone face in middle school. I had no idea why. I always thought I was just like normal. But my friends, they said you don't even have a live face. So I think this really helped throughout my career and my education. I have this knack for just like putting one foot in front of the other, just taking the next step, just one, and then just one more. I do this in my physical exercises. I do this in any kind of training and studying, and also in investing. For me, it was all just numbers, statistics, probabilities. If you take a loss, then it's because you have to take a loss, because that's the only like really good decision you can make. Okay. But then when I was 47, but that was like 5 years after retiring. So five years later, after having been retired for 5 years, I had like worked on myself, just like worked on meditation, worked on like trying to understand things. And I had like this psychological breakthrough. And after that, it's kind of both easier and more difficult to take a stop loss. It's more difficult because I'm more emotionally involved. I'm more like a normal person these days. I mean, I cry when I see a movie or when I see somebody happy or somebody sad, and I can feel losses being important, both personal and financial. So that makes it more difficult. I can really feel it. You feel the pain of taking a loss and it becoming irreversible once you've taken it. But on the other hand, I'm also this deeper connection also makes it easier to take the decision earlier. Maybe because I know how painful it will be if I don't take it soon enough. So actually being more connected means I do it quicker, even though it will become more hurtful than before. And I think I couldn't have been able to do this in any productive way before, during the main part of my career.
Yeah.
But after this like awakening, I think I'm an even better investor than I was before, but in a completely new way. But the real answer is that I was a robot.
Oh, krass. Okay, that's a crazy story. Yeah. It's hard to imagine, like, if you're not like experienced this, like to go into this, or like to think or put yourself into this like position, or it's like probably very difficult to like really understand from an internal point of view. So okay, but I think I get like the idea of you being like, this was the worst that could ever happen, and everything else is just noise, or so maybe like it's just money and whatever. So it's not like that big of an issue, and like
And it was so tough and hard and like deep that I had no idea that I had this problem or affliction I had no idea until the awakening. So for those 39 years, I thought I was like completely normal. Like, what's wrong with everybody else? What are you talking about? What do you mean you can't sleep because you have like a huge loss coming up, or you have or you're managing $1 billion? What do you mean it weighs on you? It's just numbers. So that was my attitude to it all until I like had this revelation when I was 47.
So, and in terms of like keeping up with the volatility and everything, this was an advantage because it didn't like weigh on you that much as it would on others and everything.
Yeah, so all the noise got filtered out, and I only looked at the signal.
Yeah. Okay. Yeah, great. Thank you very much, Mike, for your time.